Thanks so much. We're all settled in, and welcome to our January LLP breakfast. We are excited this year in 2006. We have slightly changed the firm in the sense that we've gone LLP, and we now have new partners, David Smith, who is over in the corner there, Suzanne Montag over there, Justin DeVries, who's joined us from Fraser Milner, and former partner of Fraser Milner, and Craig Vandersee, former partner of Goodman Carr. So as a firm, we're very excited about where we're moving, and we have a great group around us as well. We've got Ann Worker here, who's going to be one of the speakers, and we'll talk a little bit more about her in a moment. Jordan Ayton, the two main speakers today. John Smith has joined our firm as well, helping us on all angles of the estate administration and will drafting work. Paul Trudell is back in the corner. Everyone seems to cover in the back to stay out of the range of the questions. And Sean Graham, back in the corner, big surprise. Bianca Leneve is also an associate of our firm who's actually ill today. Flu, unfortunately. And last you appreciate that. Last but not least, my father, who is not here, he's at that stage in life where weather seems to run his life. So the rain is not going to get him out of bed. Anyway, we are really excited today to take our second phase of the last seminar that we had in the fall, which focused on some of the substantive and some of the particular issues that relate to passive accounts, and the presentation is more dealing with concepts. And today we're going to work through a set of accounts. We've provided our paper today with a sample set, a sample judgment, a sample order for directions should it get contentious, not that it happens, and finally a bibliography and an article written by Jordan Ayton to talk about some of the concepts that Ann and Jordan are going to talk about today. And I mentioned earlier Ann and Jordan, both of whom are counsel to our firm and play an integral role in our day-to-day practices. Both of them have more of a solicitor's practice and a solicitor's bent. And as our firm has sort of worked mostly in the litigious and the contentious area over the years, it's been a great help, because as we all know that when you litigate over these matters, they are all solicitor-based and difficult issues, that they've been a great help to us with John Smith as well. And we really appreciate their role in our firm. Today they're taking a bullet and trying to work through a set of accounts for us so that we can get a better understanding of what is the non-contentious right way to do things. And from time to time, certainly I may pipe in with some comments from a litigation standpoint, but this is really, truly, our view is the best way to avoid these problems is to do the accounts right the first time. We hope that some comments today will take us a long way to that. We'll also be we're online. We have some series of call-in participants, which we welcome and thank. And of course, we're going to take some questions at the end. We're also going to stick around a little bit after so that we can fill in any gaps that may not be met within the 1 hour. But I have a strict rule of this ending at 9:30, so we can all go out our living. So without further ado, I'd like to have Ann Worker start the seminar. And as long as everyone's got their paper, and we'll start working through these accounts and working through this thing.
Thank you. This will be a relatively informal breakfast seminar, so we've got some accounts. We're going to welcome some exchanges with you here. I think many of you will probably know accounts better than John and I. So we certainly welcome your points of view. I know that accounts are not done the same by everyone, and that's because accounts are more than art, they are a science. And so I want you to bring, when you look at a set of accounts, I don't want you to be afraid of them, because at the end of the day, all that you're doing is showing what's happened in the state, and you're reflecting the transactions that have occurred. And there's no real wrong way. If you look at the rules and what you have, a statement of receipts, a statement of disbursement, an investment account, well, that's all you have to have. That's all the rules say. There are certain customs that have been created. I know that's the wrong way. You don't charge compensation this way. You don't do it that way. But at the end of the day, as long as you can explain what it is you've shown on a piece of paper, then there's nothing wrong with your accounts. As long as they balance, that's big. That's not balance. And if they're not balancing, that's a good indication there's something wrong, you're not reflecting them correctly. When you get a set of accounts, of course, the first thing you've got to do is look at the will, because the will is your map. It is what it is, where you are supposed to go with these accounts. And there's too many times I'm asked to look at a set of accounts without being given the will, and I say, well, that looks okay to me, but maybe she shouldn't be getting this money, or maybe this is the wrong thing to do. So certainly take a look at will. And I will talk about that a bit further once we start talking about the investments. So you take a look at the will. What Gordon and I have prepared is a set of accounts. There's not that many transactions. These are not perfect accounts. They're good accounts, I think, as you did them, but they're not perfect. And that is because we want to give ourselves something to talk about and explain where these accounts could be improved upon, be interested in your point of view. And again, our accounts are different than what I've seen other service providers when we prepare accounts. They do slightly different from ours. I'm not saying that ours are the perfect model. I'm just saying this is one example of a set of accounts and how to explain how receipts are shown, how the assets are shown, so that you have a guide. So these set of accounts, F. Gavin, Mr. Gavin died leaving his spouse and his children. And the will says it's basically a spouse trust with income to the spouse for her lifetime. And the power to enclose. The trustees have the ability to enclose on behalf of the spouse. The remainder on the spouse's death goes to the children. And I think that's really all you need to know because when we get the investment issues later on, we need something on investments. So, you want to just hop in there on the original assets?
I will hop.
Okay, so he died in 2004. This is
Good morning. So I'm charged with looking at the original assets, and that's because it's the easiest, I think, one to deal with. Mr. Gavin had a bunch of assets, and that's what this list of original assets reflects. It's a valuation of the assets owned by the deceased and that form part of the estate as of the date of death. Some of them are really easy. There's see this, where that world is from, but it's great. I'm playing with it. $40,000 Canada Savings Bond, we value at $40,000. It just goes in there. But on the date of death was January 31st, and there was accrued interest for the month because it was due November. It's paid annually. There was the months of November, December, and January interest, and so that was accrued to the date of death. So that's an original asset. It's $600. The next asset was a Government of Canada bond, face value $75,000. Turns out that as of the date of death, the interest rates had gone down. So it's a 7.5 interest rate, percent interest rate. So it's valued at a higher amount because interest rates have gone down. It's worth more. So we're doing a fair market value as of the date of death. And again, there's accrued interest on that bond that hasn't yet been paid as of the date of death. We have some shares, some stocks. Those are just valued as of when you look it up on the internet, you figure out what the date of death, the price per share was, and multiply it by the number. And then we've got shares of My Own Co. Limited. That's a private company that was owned by the deceased. Now we valued it at $1. And as we all know, valuation of private companies is not an easy thing to do. But if you don't know the true value and you're doing your probate application, you can always give that undertaking to the court that you're going to value that company and then pay whatever probate fees you ought to on it. Ann and I had a little run through of this, and we talked about why you would value that company as soon as you can. In this case, I guess we have a spousal rollover, so we may not need it immediately for tax purposes, but we both agreed that it was probably the best idea to have a valuation as of the date of death, so that first of all, one of the reasons is it's going to be generating dividends, and as we'll see in the revenue receipts and the investments, you should know what value to put on that company to see if the dividends that it's generating are relevant to the value of the company. So that's one reason why you may want to value it pretty early on. The easiest entries are the bank accounts, and basically you just take those numbers right off the statements from the date of death, and you put them right in. Again, there'd be accrued interest maybe on the bank account as well. We've included in an original asset this Canada Pension Plan death benefit, $2,500. Again, Ann and I had a little debate as to whether we include that as an original asset. I generally don't include that as an original asset, but some people do, being that it's an entitlement that arises on death. Again, it's going to show up as a receipt, so if you don't list it as an original asset, I wouldn't be overly concerned about that. Then there's some pension checks that were received but not cashed yet, and those go in as original assets, and a car. And lastly, we've got some real estate, and it was mortgage insurance. So we have a valuation for the property. We've got a mortgage there as of the date of death, and we've got mortgage insurance. Now, whether we include that as an original asset, do we include that mortgage insurance as an original asset? It's not payable to the deceased. It's payable to the bank, the mortgagee. We've included it as an original asset. Again, I don't think there's a rule on that, so if you didn't, you would be okay, I think. I don't think that's a big issue. Although the more information you give, the better it is. So the more you know about the estate, the more you can tell the beneficiaries, the better it is. And again, that's what this is for. It's for the beneficiaries so they understand, and for the court, so they understand what's going on here. And then we've got some miscellaneous personal effects, etc. On the right side here, how disposed. This links to the capital receipt. So when we receive one of these assets into the estate, we show it, we reference it against the capital receipt. We'll show that in the capital receipts in a second. If something hasn't been realized, we indicate that it's unrealized. Sure.
And now I want to say some things you might want to some things you can improve on these accounts. I mean, accounts of perfection. You might want to put the most liquid assets first. In other words, the order of these original assets is a little bit haphazard. We've got bonds and we're ending up with this, or maybe it's just reverse. Anyway, in terms of the order, there's no right or wrong. We might want to put most liquid assets first. I'm frankly not to place out the grammar of how disposed, but that's just my own personal preference. That's how disposed sounds kind of weird to me. And I want to point out also, as far as the mortgage insurance, do you pay probate fees on that mortgage insurance? It's something that's paid, as Jordan pointed out, as the mortgagee. You get a deduction for the mortgage, but the mortgage insurance is actually going to pay it off. So there's an interesting question too, and I'm actually not sure what the right answer is on that one, whether or not you want to. Yes, sir.
Yeah, I'm going to come back to the Canada Pension Death Benefit.
Yes.
That's on the presumption that the estate has paid for the funeral, etc.
No, actually, it's not on the presumption that the estate is paid for the funeral. The question was that you get the death benefit, assuming that you paid for the funeral. And the fact of the matter is that Canada's pension, the death benefit, is payable if the deceased is paid into the pension plan, is already receiving Canada's pension. But under the rules, the death benefit is paid to the estate trustee. It's only if the estate trustee does not apply for the death benefit. It is something that's owed to the estate. It's only if the estate trustee has not applied, or there's no estate trustee, that the person who has paid for the funeral, upon proof that they've paid for the funeral, will then be paid the death benefit. So, in fact, they ask for, when you apply for the death benefit, they ask you for proof of the funeral payment. Again, half of these resistance, I'll include that. But the fact of the matter is that if I'm the estate trustee, I don't need to show it that I've paid for the funeral. So, but it is a good point, because if you're doing these original assets, you may not know $2,500 is the maximum. You may not know. You may only get $1,560 or some lower amount, and they only pay the small amount of county pension in. But assuming that they pay the county pension and work for most of their lives, then get the grand sum of $2,500, which of course, as we know, is taxable, so it's only going to worth that much.
Basically, question really is, the $2,500 is for payment of funeral expenses, et cetera. In the event that it's not included in the statement of
Yes.
accounts, but yet one of the disbursements is the payment of the funeral expenses, that it's a fair question to ask. Why? Where did the $2,500 go?
Yeah, no, it's really, the question was, let's say, the way I understand the question is, if the estate is not paid for the funeral and someone else has,
No,
and you receive the
no,
benefit.
it's paid by the estate, but not included in the statement of accounts.
The funeral is not included in the
No,
statement.
the $2,500.
Well, if someone else is paid for the funeral, I guess if you're preparing the estate accounts, you're assuming there is an estate trustee who is accounting. And if someone is an estate trustee and someone else is paid for the funeral, I'm assuming you're going to find somewhere in those accounts either a reimbursal of the funeral or a payment of the funeral. So it really, in this situation, if you've got a set of accounts, it's very unlikely that you're going to have the funeral not recorded somewhere. Though I have seen sometimes they show the bank account after the funeral has been paid. And that is something else in terms of, they don't do the bank balance as at the date of death. They show the bank balance reduced by the amount of the funeral because someone else has gone into the funeral bill and the bank has obliged them to pay the funeral bill out of the deceased bank account. And how do you show that? I prefer to show the full amount of the bank balance as at the date of death and then show the disbursement of the funeral. And then you leave it for someone else to say, well, you didn't actually pay for the funeral and you shouldn't get 2.5% on that $7,000. But that's another issue. As far as clear recording, that's really what we're talking about here, is showing exactly what there was at death, what's come in subsequently, and what's gone out subsequently. Yes, sir.
You have a bank account and you owe money to the bank under a line of credit
Oh, yeah.
relating to that account. Would you put the net amount of the bank account in, or do you put the gross amount?
Well, it's really a liability, isn't it? I mean, you should. Yes, sorry, I'm going to repeat the question. Did anyone hear the question? Did you? Okay, anyway, the question is, if you've got a line of credit, if you have a liability, it's a debt. So, isn't that, you owe money to the bank. And so, in fact, your bank balance might be negative. For example, let's say you at one bank you have a positive bank balance, and the other bank you have a negative bank
So
balance.
it's the same bank.
Or the same bank. Two different accounts. The amount owed is a liability. And like the mortgage insurance, can you show me down the mortgage insurance? Down at the bottom, the liability. There's the mortgage. Yeah. That is, oh no, sorry, you should go down to liability. The mortgage liability there is shown as a debt or a credit, I'm not sure which one, but it's shown as a negative number. You could have there also, you could have amount owing to the bank, and it would show as a liability. So in fact, your net asset, let's say you have a liability of $20,000. Now, I have seen account preparers show the liability as realized on the date of death as a disbursement of $20,000, even though it actually hasn't been paid off yet. That somehow they try to bring it in originally, but that is really contrary to what a state account is. In other words, original assets and original liabilities are not brought into the accounts until some cash, some in or some out is happened. So the original liability is treated like, in my opinion, the original asset. In other words, it's shown as the books as either original liability, and then it's paid off. Then it's shown as a disbursement in the accounts of the cash flow.
So it's the same probate fee, you pay it on the net amount or on the original bank?
You actually pay it on the, you do not include the debt, right? I mean, our probate fee says you have to pay that tax on all assets in the estate, but do not include the debt, except debts on real estate. And that's why the estate account, you're not going to have necessarily, the estate accounts are not necessarily going to mean everything that's shown as an asset, or everything that's shown as a liability. The net figure on the total fee, the total assets, that's liabilities, is not necessarily what you are going to be paying probate fees on. Okay, they're not going to necessarily be the same number. I'll move on. Thank you. Okay. Moving on. I may not want to have enough to say. There we go.
Okay. The next page, which is probably the most important one, as Ann had said, these accounts have to balance. So this is a simple sheet. You take capital receipts, capital disbursements, you have a balance, revenue receipts, revenue disbursements, balance, and then so you have a total number, and that's got to equal what you actually have. So you scroll down, you see that we should have $126,000, and sure enough, that's what we have. We have $94,000 invested and $31,000 in the bank. There. Okay. If they don't balance, of course, that means something's wrong. Unless you look and there's some fudging number somewhere in the accounts that say to balance X dollars. I'm not going to go into too much detail on the receipts. I'm going to make a couple of comments though. The first comment is that these do not have to match the value of the original assets. Okay? So, because when an asset goes into capital receipts when it's realized, so if, for example, the house was worth X dollars on the date of death, but when it's eventually sold, it's worth X plus 200,000. It's the X plus 200,000 that you realize on the capital receipt. So that those numbers do not have to match the original asset numbers. Just want to make a couple of points, and one has to do with the accrued interest to the date of death. We've included, right there, we've included the accrued interest there and on the bank account. Sorry, yeah, I'm just going to find it here, and then we can. There it is. Here we've got realized the bank account value and accrued interest to the date of death. Okay. Oh, yes, sorry. We're on the capital receipts, item 7. So accrued interest is a capital receipt because it's prior to death. It's not something that's generated from the assets after death. That's why you'll see accrued interest as a capital receipt.
That may be one reason why you may not balance, because when you actually receive the interest, you may have forgotten that you put some of the interest in the capital account. So you've got to make sure that when you actually receive the interest, that you've shown that some of it's gone to capital and some of it's gone to revenue. And that may be one payment.
Okay. Just briefly, we're on the capital disbursements page. I just wanted to raise one issue here that you might see. We've got a payment, item number 7 on the capital disbursements to the Receiver General. It's the balance of the T1 tax owing for the 2003 tax year. Well, that ought to have been paid before that date. So some amount of that probably relates to penalties and interest. So you'd want to break that down. If part of that dealt with or related to penalties and interest, you'd want to break that down and explain exactly what part of it was related to penalties and interest. Similarly, number 8, I think, it was due. It's paid on July the 15th, but it was due on April the 5th, on April 05. So it's late. So there's probably penalties and interest there. Turning to revenue receipts. As I mentioned originally, the original asset of My Own Company Limited, this is, for example, it's item number 8 on the revenue receipts. We have it worth $252. Dividend was declared at $252. Well, that's a dividend on a company that's worth $1. So when you value that company, when you put it down, that's a question you're going to want to ask if you're looking at these accounts: is what's this value of the company, and why is it generating money, and is it generating enough money relative to its worth? So that's why the evaluation of that company is important for the beneficiaries. I think we'll turn it over to Ann to deal with the investment account. I just want to point one issue out on the disbursements. What you don't want to see in a capital disbursement, if you're looking at this from a beneficiary or as the estate recipient, you don't want to see a purchase of an investment as a capital disbursement. You don't want to show money coming out of the estate to purchase an investment in the disbursement, because what you're using is the money that you've already realized, and you're going to be investing that, reinvesting it, and it's going to come back in. You don't want it to have double counting of that same money. And that's what will happen if you show a disbursement out of the disbursement account for investment, for purchasing an investment. Similarly, you don't want to see as a receipt the proceeds of an investment that you as the estate trustee just purchased, because you've double counted that money. You counted it once when it came in originally, and when you invested and it comes out of the investment again, you counted it twice. So that's what you don't want to see in the receipts and disbursements.
The investment account is generally where people have the most trouble in doing the estate accounts and how you deal with profits and losses. When you look at an investment account, there's a couple of things you want to look at. Are the investments authorized? You want to look at the will and the investment authority in the will. And assuming it's a trustee investment or you're authorized to, whatever the trustees deem prudent, you look at them and see whether or not they're prudent or not. And there's also larger issues in terms of even-handedness, but I won't go into great detail about that. That certainly is an issue, whether you get enough income being generated for life tenant and whether you've got enough capital growth for the capital beneficiaries. But those are issues in general that you want to look at a set of accounts. One of the other things, too, is if you've got more than $60,000 in one particular bank, as you know, the Canadian Deposit Insurance only insures up to $60,000 per institution. I think the institutions are pretty good at offering products at all their subsidiaries and related companies, so that you can go to one institution and have investments or term deposits under the same umbrella. But that's another thing that you want to look at. Has the personal representative invested in their own, and they can self-deal, and whether or not there's authority to self-deal. So these are, in general, looking at the quality and the nature of the investments. Investment accounts, I've seen them being treated differently, but as Jordan said, they are a subset of capital. They're not a separate receipts and disbursements. What the investment account is showing is how is the money that you've received being debited in the hands of the trustees. They've received a couple of $100,000. They've realized some assets. What have they done with that couple of $100,000? That's what the investment account is reflecting. It's showing what's been invested, what's been purchased, and what's been sold. I prefer to see, this is the pointer here, and again, there's no right or wrong here. Sometimes I got to purchase 200 shares in that solid company. That's oh yes, of course, we've done. We're on the investment accounts, and we are at item number 3. I prefer to see the cost of the purchase being shown in the accounts in one spot with an explanation. Some people do it differently. Some will show the broker fee somewhere else, or they'll back it out. That, for me, is the cost of the investment. That's what it costs you to buy. Now, 200 shares, you've got to show the number of shares you bought, the price that you bought them at. You don't want to go before Madam Justice Greer and have her complain, as she did, the estate has not properly set up the investment account. We have no way of knowing the actual purchase cost of the shares or what brokerage fees were charged. If you get before a judge who knows her accounts, you do not want to have those types of details missing. So, again, as much detail as possible is important in accounts. So we've shown what the purchase price was and what the brokerage fee is. That's the cost. There were also some fake shares that were sold, or purchased, and that's item 5. So there are 250 shares in the fake company, $100 a share, plus the brokerage fee. And we're showing the total cost. I always got confused with debit account and credit account. I think most people are. Well, what does it mean? And that thing. So it's helpful here to say, well, that's what the purchases are and that's where the gains are. Those are the columns you're going to put them in. And again, some people prefer to have all of the purchases on one statement and all of the sales on another statement. Whether you show them on one page or two different pages, you show them in blocks. Again, there's no right or wrong to this. This is a format that I find is easiest to read. That's all. I want to go straight to then item 9, which is the... Yes, sir.
Number 1 on the investment account you bought at GIC for $38,000.
Yes.
It looks like on number 6 you realized $38,000. What do you expect to do?
Yeah, the question is, we're looking at items number 1 and 6, which are perfectly balanced. There's the purchase of the GIC and the redemption of the GIC. Really, that's not really a sale as much as it is a redemption. The interest is shown in the revenue receipts. And thank you. So that would be item number 10 on the revenue receipts. Thank you, Joy. And that's because that's more money that's come in rather than going out. So that's got to be shown somewhere coming into the accounts. Yes.
Okay. Then on item 3, you purchased 100 shares at $20,300. And item number 10, you gained those shares at $29,500.
Yes, I was just going to get to that. Yeah, that's interesting. When we purchased the solid company shares, when we sold them later on, there was a profit on that sale. And the profit was $9,200. The difference between the purchase price and the sale price has to be reflected in the investment account, but if there's more money coming in, then it also has to be reflected in the capital receipts. Now, it's different than GIC interest, because the GIC interest is an augmentation of income, right? It's income coming in. Whereas the sale of the shares is a capital receipt. You've got a capital gain. So capital gains are shown as capital receipts. And these certainly, and what I said is the profit, capital receipts number 13, is shown as a capital receipt there, 9,200. And similarly with the loss on the sale of the flake company. So losses are shown in capital disbursements, profits are shown in capital receipts. And my investment account still balances, you see, because the differences between the ins and the outs are transferred to the capital receipts. You're going to have a corresponding entry in the capital, on the other side of the sheet, of the ledger, basically.
And would you not cross-reference, for example, what that chapter's raised effectively, see interest in, on the other...
I think cross-referencing in all situations is always the better accounts. In all situations, if you've got entries or you've got transfers, you always want to see so certainly these accounts will be improved if there was some cross-referencing as we had in the capital gains. So it becomes more challenging for us, and what we haven't got there is if you have dividend reinvestments. Because let's say instead of you had a dividend but it was reinvested, you'd have to show a purchase. You'd have to show a revenue receipt, but your purchase is also going to be shown. You're going to be purchasing more investment. So if you've got a dividend reinvestment, you've also got to show it as a revenue receipt and a purchase of additional units. Because when you've got a dividend reinvestment, you're just not seeing, that's what's happening here. You're receiving dividends and you're using those dividends to purchase more shares. The accounts have to show that. Compensation on investment, and I think this is also something that gets very confusing to run. I'm wondering if you could please put me over to the compensation statement. So I'd like you to move now to page 15 in the statement of compensation. People often miss this, and compensation on gains and losses, you're only compensated, or the rule is, the custom is, you're only compensating on net gains, not on gains and not losses. So in fact, losses have to be deducted from both your capital receipts and your capital disbursements. And I find this separates the women from the girls. So If you look at a compensation statement and you don't see those losses deducted on both sides, then what's happening is the executor is getting compensated on their gains, and they might have lots and lots of gains, but at the end of the day, their losses, they've only ended up with a $500 net gain, and that's really what you're compensated on, is a net gain, what's really coming in. So you're not compensated for churning the account, getting lots of gains and lots of losses. You're compensated at the end of the day for how much you've increased the value of the estate. I think that's all about the investments. I have some other. Okay. You've also included in the materials there a draft judgment, assuming that the accounts are passed in the form that they are in. I will do the draft judgment, and then I will get the consultation to take you over to. So we've included a draft judgment in the accounts. And it's on the screen, so and that is not a closed passing. So you provided your account or notice of the application to everyone, knows objectively you get this judgment. And I'm trying to know this on there. There's actually a mistake in our
Explaining to the judge why there's a mistake in the judgment. It has to do, if you go to the judgment and you're looking at paragraph 4, it's the way we've allocated the compensation as between capital and revenue. I want to make one point first, that we're only separating revenue from capital in these accounts because there's a life tenant and an income beneficiary. If there is no income beneficiary, then there's no need to figure out this is capital, this is revenue, this is a disbursement from revenue, this is capital, should this be capital? It doesn't matter. You can do them all as receipts and disbursements, unless there are two classes of beneficiaries, that is, an income beneficiary and a capital beneficiary. Okay? That'll make the job a lot easier if there's no income beneficiary. Anyway, the way we've dealt with the compensation, when you allocate the compensation claimed against the capital or income, you basically take the total capital compensation, which is which is on your statement of compensation. If you notice, there's the total capital compensation there of $18,318. Well, that goes against capital. And then there's revenue compensation of $778. Well, that goes against revenue. Right? What we've done here is we've allocated 2/3 of the total compensation against capital and 1/3 against income, which is not correct. The way you do it is the capital compensation, the compensation calculated on the capital goes against capital, and the compensation calculated with respect to revenue goes against revenue. The only 2/3, 1/3 deals with care and management. And the total care and management under our calculation is about $6,300, and that's where we start dividing 2/3 of that against capital and 1/3 against revenue. Okay. I want to talk a little bit about, two issues. One is the unrealized original assets. This is where accountants can't figure us out. And I'm always concerned when a client says one of two things: I'll do the accounting myself, or two, my accountant's going to do it. Because accountants don't deal with, they don't like the idea of book values. And what we have here is, these are assets that haven't been realized. So then these values, you'll see, reflect precisely the value of the original assets. We don't show that now the 1,500 shares of BCE have increased in value or decreased in value. We show the value as of the date of death. They're still unrealized. We don't know what their value is going to be when they are realized. So they're date of death values.
I think it is helpful if you want to show the fair market value, show that too. Again, more information the better. If I was a beneficiary, I'd say, I want to know what my own company is worth. And of course, if you're calculating care and management, given the fair market value in order to calculate the care and management. So our executor missed out because he only got care and management on $1 of this company, and it might be worth $1 million. So you want to, again, more information, the better on these accounts.
I agree completely with that, because really that's what causes problems for beneficiaries, is the lack of information or questions. I'm going to just briefly turn to, and it's not going to be in the accounts, but it deals with compensation. There's a paper that I did a little while ago on a new tariff guideline, question mark. We're familiar with the idea that you get 2.5% on receipts and disbursements, and 2/5 of 1% on the for care and management. There's been a move, or at least there's rumblings of a move to increase those percentages from 2.5% to 3%, spurred on mostly by two legislative amendments that happened in the last 5 years, and they are the tariff for guardians and attorneys for receipts and disbursements under the Substitute Decisions Act. There's a regulation to the Substitute Decisions Act that says that attorneys under a power of attorney for property and guardians of property are entitled to 3% of receipts and disbursements and 3/5 of 1% for care and management. That is the first time that we've seen in legislation the actual tariff. And there's that issue, and people say, well, if guardians and attorneys are fiduciaries and so are executors, why should executors be compensated at a different percentage than attorneys? And the other issue is that the Public Guardian Trustee Act was amended to permit the PGT to take 3% on receipts and disbursements and 3/5 of 1% care and management for estates that they administer. So occasionally, well, not more than occasionally, the public guardian trustee will administer estates where there's nobody else to administer them, and they get compensated for being an executor at 3%. So certainly an argument could be made that we as individuals or trust companies should be compensated at the same rate that the public guardian trustee is compensated for doing the same job. Similarly, with respect to attorneys and guardians. There have been attempts to increase that guideline, and I've referred to a case called Reed Morton, where Justice Lane said no go, at least at that point. He wrote that, so there be no misunderstanding. Let me make it clear that if the trust industry is not prepared to subject its case for an increase in the guidelines to the test of cross-examination, it should cease to press the issue. Well, that case certainly is helpful to dissuade people from charging 3%, but we do see it from time to time at 3%, and I think that you'll see more of it, and I think that the trust industry and others, other executors, depending on the estate, will see that 3% makes more sense than 2.5% and make a case that if the PGT is getting it and attorneys are getting it, that they should get it as well. My paper also just explains the idea that these guidelines are not carved in stone for executors, and that it comes back to fair and reasonable compensation and the 5 factors of time and skill and responsibility and size, et cetera, and success. So that still is in the mix when we go to argue compensation. I thought, well, perhaps let's deal with questions and then. Sure. Okay. You were giving directions? Oh, go ahead.
The draft judgment, the capital receipts and disbursements, if you look at the reconciliation page on the accounts, you will see those figures repeated: capital receipts, total, capital disbursements, and the net amounts are shown on the draft judgment. I particularly want to draw draw your attention to Schedule A, because when we say that the Schedule A only includes original assets, again, to improve, I'd like to improve on the rules, and I prefer the Schedule A to show everything, to have a full picture of what it is you have on hand at the end of the day. Because as you know now, when you pass accounts, it used to when you pass accounts, the same file was coming up again. You had the same file number, and you had the old book set of accounts. It's often now, you pass accounts, and you don't have the previous set of accounts. The court doesn't have the previous set of accounts. And all you've got are the records that you have, or a draft, or a judgment that's been signed. So if all you're working with is a judgment on the previous set of accounts, it's so helpful to have a picture of what you have on hand at the end of the day, what the investments were, what the assets were, what the cash was. And that should tie in. It should, again, tie in with your reconciliation page. That means when someone looks at that judgment has been signed, they can know exactly what's in the account for the purpose of starting on the next set of accounts that revenue is jotted. So that's what I wanted to bring to your attention.
Okay, so can you just walk through the judgment, where we're getting our
I'll just, yeah, I do the reconciliation page, the capital.
Just walk through.
Okay. So it's not tab, if you look at your sample judgment on the capital accounts, you'll see the capital receipt is $434 and $115.71. And that's the figure that's shown in your total capital receipts. The total disbursements is shown as well. And these are the figures in net amount. Those are the figures that are going to pop into your draft judgment. That's out true. Okay, all right. Do you want me to Yes.
I've done some fascinating things where the differences between, say, the opening of the book value of the cost, let's say the gain, does not show up as a capital receipt and as a revenue receipt. Is there discretion there, or
It depends on the nature of the receipt. And I guess if you look at the bill, and there's even hand issues at play. I mean, I actually think I'm giving them too much of the benefit of the doubt. They've got the power to allocate receipts between revenue and capital, and so they decided for even-handed purposes, they're allocating one to the other. They've stock dividend, or there's some reasons for allocating it. I don't think, ordinarily, if you've got income, it shows in revenue receipts, and you've got a capital gain, it's going to show in capital receipts. So I think that could be a mistake, but whether it has, again, if you've got remainder, it depends on whether or not you've got a difference between the life tenant and the remainder person. At the end of the day, it makes no difference. But if it makes a difference about who's going to benefit from that money, then you want to make sure it's on either the revenue receipt or the capital receipt. Yes.
I realize that this is a simple set of estate accounts, but for people who are preparing accounts, you should point out that a lot of trustees now invest in mutual funds and in trust units, like mutual fund trust units, and those have special accounting things. Not only do they have in mutual funds, not only do they typically reinvest dividend, but they buy more units. You need to make sure that your investments reflect the new number of units. For the income trusts, often there's a return of capital. Yes. That has to be included in your investment account.
The question is, I mean, investments are very complicated. Of course, income trusts and mutual funds are very difficult to account for in trust accounts. And I think that's true. There are its return of capital, the income trust has to be reflected in the accounts. But the return of capital, you're not getting any money in. So how is that reflected? I mean, that's not going to be a receipt.
Well, actually what it's done is it's reduced the cost of your investment. When if you purchased a trust unit, and at the end of the year they send you a T3 statement that shows return of capital of $3,000.
Yes.
You've actually, over the course of the payments that you've got during the year, received that $3,000. So in a way, you've got back that much principal. So your original investment cost is reduced by $3,000.
Yeah, that makes a lot of sense.
And you need to be careful to not ignore that.
Yeah, I think the problem is also with mutual funds, often it's not until the end of the year that you find out whether or not you had an income receipt or a capital receipt. And I know a lot of people in the industry are very upset when they get their split from the mutual fund on March 30th. They've got basically 2 days to turn accounts around, and this is a problem with the mutual funds and how to account for these things.
And what would you suggest doing if you're presenting board accounts, say as of December 31st year end? You're in that situation where how much of it is customer distribution? You don't know the allocation until after the
I think again, just the question is, if you don't know what the allocation is on the receipt, whether it's a capital or revenue receipt, because you haven't got the slip yet from the mutual fund company, then I think as long as you show them that you asterisk it and say, E and OE or whatever that expression is, it may change later on. So that you point out that this figure is subject to adjustment. And if you can estimate it, of course that may be helpful. But if you don't have any basis upon which to estimate it, then you've got a problem. You have to slap it in one or the other and say, this figure may change. And that's really the best you can do, I think.
How would you account for situations where, say, the estate has one or two private corporations, and they're active, and the private corporations are dispersing monies on behalf of the estate, and the estate perhaps is not in the money, and it's done by way of time terms of adjusting entry. So it's not clear through an estate bank account but through the private corporation account.
Again, I don't really care. The question is, how do you deal with monies that's being paid by a corporation that's owned by the estate trustees? So one of the assets of the estate is a wholly owned corporation, and the corporation, they're using the corporate bank account as if it was an estate bank account, really, and they're using it to pay estate expenses. It's helpful in those circumstances to have some type of ledger, a schedule in the accounts, showing the amounts that have been paid by the corporation. So the detail is shown on the schedule. So the corporation paid for the funeral, the corporation paid the rent, paid the property tax, paid all these things. And at the end of the day, the corporation is owed by the estate a certain amount of money. And those totals, so then on your accounts you could say, when the estate pays the company, so you see a disbursement in the account which says, paid to XYZ company in accordance with Schedule A. And then you can go to Schedule A and see what that disbursement reflects, all those details of what that general figure reflects. That's the way I would do that.
Yes, question for Jordan. Here, you referenced the compensation tariff guidelines, and you also referenced powers of attorney in that discussion. Where do you have, is there precedence where a standard form power of attorney with the non-spec that there should be no compensation? Is there precedence to state notwithstanding that the attorney would be entitled to compensation?
The question was, if the power of attorney states that the attorney is to act without compensation, is there a way to get the attorney? Is the attorney still entitled to compensation some way or another? The SDA talks about that the compensation is subject to the terms of the power of attorney. So there is no entitlement to that if the power of attorney says that they're not to be compensated, they're not to be compensated. It's similar to the provisions of the Trustee Act that says you get fair and reasonable compensation subject to the terms of the trust document. So if that person takes, and there is case law to say that if you're acting and there's a compensation agreement or there's a waiver of compensation or request that you not take compensation, and you act, you're not entitled to compensation.
Even though the attorney was not aware of that?
Why wasn't the attorney aware of it?
Well, that position as the donor was the one that made the power of attorney.
Right. Well,
the attorney was the one.
right, but the attorney could renounce the position and say, I'm not acting without compensation. So once you assume, like that's why I say, once you start, you assume, certainly there's precedent with respect to an executor.
I've got 2 minutes here, and I want to.
I did an example for where there were this mutual funds, so numerous transactions, numerous funds, and the company, like from time to time, will receive several units as administration fees. But when we did the calculation, they don't really balance. So how do you account for that? Because in the end, the estate trustee decided that it's not worthwhile to go into each transaction to calculate the difference. So we just write a note.
Are you saying that the units were used to pay fees? So that goes money going out, so that would have to show presumably as a revenue disbursement or something because it was used to pay fees, which reduced the amount we have invested, reduce the total amount because so you'll show a sale or redemption of units.
Yeah, but then the units that were sold at the time, if they gave you the units at the unit price and everything, they don't equal the actual administration fee taken. So we wrote to the contract to the bank. The bank just gave us the allowance of conduct. So it's too much to go back to try to work out each transaction.
There might be a de minimis principle, that obviously you don't want to spend $300 or $400 worth of time to work out 20 cents worth of difference, and that's why sometimes we might want to use an adjusting entry to show, well, that $3 is somewhere here to do with this fee that the mutual fund companies, and sometimes also you can use totals. So instead of, I sometimes, if I don't want to show an interest of 30 cents each month, I will say annually I'll show that receipt as a total figure if it's just more convenient, and it's just going to depend on the circumstances. So in your situation, if the difference is really not worth the examination, then you're going to have to show an adjusting figure somehow to reconcile the difference. And that figure is going to say it's going to show a disbursement fees, management fees, I guess, management fees, and that's going to be the difference. But are you worried that in fact that the price of the units has changed? You're going to have to average them out each time. The statement should reflect it. The statement you're getting from the mutual fund company should show the average unit price and what they're sold at and what your. So when they sold units, it should be at the average price of the units at that particular time.
I don't want to, if you have any extra questions and so forth, it's coming up to our time. I think one of the things we've learned is that although we thought this would be a two-part series, we may have to make it a three-part series. The questions, some of these complicated accounting issues are hard to cover quickly and certainly within the time, and we'll put some more thought to it. Perhaps the next seminar we can address some of those questions. We really appreciate everyone's attention today. I hope this was helpful. These are concepts that never hurt to be worked through repeatedly so that we can get it right every time. Our office has found that the growth in this area is so substantial that we have a full-time clerk who's just dedicated to preparing these accounts because we have so much, it's a time-consuming process and so much involved with it. So hopefully today's been of assistance, and we obviously would be pleased to give any assistance in the future with any of you. Thanks again to Jordan and Ann, and thanks to everyone for coming out on this relatively crummy day in the weather.